Welcome back, everyone. For those of you that weren't here this morning, my name is Carol Comerton-Ford. I'm a Professor of Finance at the University of Melbourne. We have two great papers for you this afternoon. Welcome to those from the US who have joined, who are in bed for this morning's session. So nice that you can join us this afternoon. First up, the paper we have is called The Value of Off-Exchange Data. That's going to be presented by Tom Ernst at the University of Maryland. So I'll hand over to Tom. He has 30 minutes to present the paper.
Thank you very much, Carol. Thank you. And thank you for you and all your partners' work in organizing this conference. So this is going to be the value of off-exchange data. And let me first say the quick disclaimer, which is the ideas and opinions expressed in this presentation are the authors and should not be interpreted as reflecting the views of either FINRA or its staff. Okay. So I'm going to start my talk today by two motivating trends. The first trend is that exchange data has become increasingly valuable. So SIFMA, the Society for Financial Markets, they report that there's been an 1,100% increase in data fees from 2010 to 2018. And of course, they're an exchange critic, but the exchanges themselves have also reported very strong growth in data revenue. Year after year in their earnings reports, they report earning a larger and larger share of their overall revenue from the sale of their data feeds. And this exchange data is an incredibly high margin business segment for the exchanges. So the first trend that I want to have you think about is the fact that the value of the exchange data, at least the market value, has been going up year after year after year. The second trend I want to highlight is that off-exchange trading volume has grown. Around 1/3 of all trades happen off-exchange. With the pandemic, there was actually a surge in retail trading where there were some days last year where around 50% of all trades happened off-exchange. That's tapered back off down to around 1/3. And part of this rise has been driven by payment for order flow, that a lot of wholesalers are buying order flow direct from these retail brokerages, and the order flow never hits the exchange. So the second trend is the idea that if you think about the data, the off-exchange trading volume has grown, and with it, the data that's, the off-exchange trading data has grown in size. So if you think about these two trends together, what we're going to be thinking about today is what is the value of off-exchange data? And there's going to be two things I'm going to highlight. The first is the ways in which these are very different things, which is the facilities and reporting times around this data are completely different. We'll see that off-exchange trades are reported thousands of microseconds after they happen, when exchange trades are reported very rapidly. But the other thing I'm going to really highlight is that the participants here are often the same. So it's not like off-exchange trades are, yes, there's a lot more retail trading, but the people they're trading against are often also major players on the exchanges. So the same people are trading in both venues, which creates an interesting informational environment. In brief, I'm going to highlight three things in my talk. The first is just this delay that off-exchange trades are reported with. I'll show you that trades are reported thousands of microseconds after they happen. And this means that latency is actually a very important element of post-trade transparency. These delays are economically meaningful. The second thing I'll show you is that off-exchange trades cause market reactions. And this is something we weren't sure if we would find when we were going into this project. We talked to a lot of people who told us, no, off-exchange data doesn't have information. But what I'll show you is that there's actually a flurry of trades and quotes in response to the publication of this off-exchange trade data. I'll exploit geographic variation in data centers to be able to pinpoint these reactions and be sure that I'm seeing the reaction to that off-exchange trade report. And I'll also show you evidence that these response trades actually, appear informed. I see buy orders following off-exchange buy orders. I see sell orders following off-exchange sell orders. And these response trades are negative realized spreads. They appear to be making money. And then the final thing I'm going to talk about in my paper is that there's actually a sort of complex information flow here, which is that yes, investors trade both on and off exchange trades. So off exchange trades can actually potentially influence on exchange trading behavior. And this will tie in back to the first point, which is if you trade on exchange and off exchange at the same time, the exchange piece gets reported first. The off exchange piece gets reported later. And what this does is it kind of creates a difference between the public value of the data and the private value of the data, which is that the market participants themselves know about their off-exchange trade far before the rest of the market. Okay. Now, before I got into that first point, let me take a second to place in the prior literature. So here we connect to a lot of issues on the value of data, trading off exchange, transparency, and low latency trading. So here, what we're really going to do is bring in a new focus on off-exchange data to all these issues. So off-exchange trade in regards to post-trade transparency, in regards to low latency trading, and just the broader data value. So far, all the data value work is focused on the exchange data. So let me jump into my first point here, which is that trade reporting process. I'm going to take a second to give a quick background of the facilities involved and the embedded latencies that these facilities create. So exchanges are created in a trades are reported in a three-step process. Step number one, any off-exchange trade, at least one party is going to be a FINRA member. So this FINRA member will report the off-exchange trade to a TRF. A TRF stands for Trade Reporting Facility. It was something named by regulators. What does it do? Well, it takes that trade report and then it sends that trade report to the SIP, which is step 3 here. Now, their final step, the SIP, the Securities Information Processor, this is going to be the trades where the trades are actually broadcast out to market participants. So step 1, the off-exchange trade happens with a FINRA member. The FINRA member has a reporting obligation. They report to the TRF. Then the TRF sends the signal to the SIP, which actually broadcasts it out to market participants. And of these 3 steps, that first step takes by far the longest. So all these times are in microseconds. If you blink, that's about 200 microseconds. So this first step is about 1,000 microseconds, maybe even 10,000 microseconds. These second steps are a lot faster, less than 500 microseconds. And the variation here has to do with geography, which we'll talk about later in the talk. So just to give you a sense of the economic scales here, let's suppose that there's an off-exchange trade between my co-author, Chester, and myself, and that I'm a FINRA reporting member. So I have to report this trade with Chester. I write down the details of the trade, and I put it in a tube, send it off to the TRF. While that signal is traveling to the TRF, let's suppose I go to the exchange and I trade. I buy a few shares of stock, motivated by my trade with Chester. That's going to take about 25 microseconds for the exchange to process my trade and then broadcast it out to market participants. Now, let's suppose Jonathan, my other co-author, is also at the exchange. He sees my trade. He thinks, you know what? I'd also like to go and trade some stock. So the exchange is very fast. If he places an order upon receiving the signal of my order, that'll take another 25 microseconds. Immediately, it's broadcast out. And then let's suppose our discussant, Dominik, also sees Jonathan's order and decides to trade at a completely different exchange. You could go across New Jersey from NYSE to NASDAQ or vice versa. This whole process of me trading on exchange, Jonathan trading in response, and then Dominik going to a totally different exchange and trading, all of these things can occur before my report of that original trade with Chester reaches the SIP. So before anyone else in the market finds out about it, we could have this whole chain of events. Okay. So this is a really big difference in terms of latencies. This step here of reporting trades, off-exchange trades, is very slow, while the reporting of on-exchange trades is very, very fast. So that's point 1. The next 2 parts of my talk, I'm going to talk about what happens here in green, but the first thing I'm going to do, this part right here is the red part. I'm going to talk about what happens when that trade is finally reported. When the SIP broadcasts out that off-exchange trade, I'm going to show you that there's trade and quote responses to that new information, and that these trades really appear informationally driven. So let's start with that SIP. So here's the SIP. It broadcasts out any trades. And what we're going to look at is what happens when the SIP broadcasts an off-exchange trade. So here at time 0, that's going to be the event, that the time that the SIP receives an off-exchange trade. So just like, if you've ever seen a graph of like a merger announcement activity or something like that, time 0 is going to be every single off-exchange trade. And what we're going to look at is, well, what's going on in the exchange 100 microseconds later, 200 microseconds later, after the SIP broadcasts out that trade. And what we find is a very clear pattern of activity. So here's time 0, the SIP has the trade and broadcast it out. First, we see a huge spike at the New York Stock Exchange. Second, we see a really big spike in activity at BATS where there's very little going on, and suddenly there's a massive surge in the number of quotes going on. And then third, we see a huge spike at the NASDAQ exchange. There's a huge spike, and then it very quickly drops off. So there's a sequential pattern here. NYSE first, BATS second, and NASDAQ third. And the reason there's a sequential pattern is that this matches the geography of the markets. So everything I showed you was from a tape A security. It was reported through the NYSE TRF and broadcast out by the CTA SIP. Now the CTA SIP actually broadcast the off-exchange trade from northern New Jersey. So if you think about that signal coming out of northern New Jersey, it's traveling at the speed of light. It's going to take still some time to reach each of these facilities. So it's going to hit the New York Stock Exchange first, it'll hit BATS second, and it'll hit NASDAQ third. Now, one of our first questions is, are people looking at the CTA SIP or are they looking at the TRF timestamp? Or, is there something else going on in the market that could explain these same results? Just by coincidence, we would get that same geographic pattern. We have a couple of ways to test this. One way we can test it is to take advantage of the fact that there are 2 trade reporting facilities. One of them is run by NYSE, and that's going to be in northern New Jersey. The other one is going to be a NASDAQ trade reporting facility run by NASDAQ, and a FINRA member can report to either trade reporting facility. But tape A securities are only reported by the CTA SIP. So what's nice about this is it provides actually a second path to the market. So if we were thinking, what if there's something else that's happening around the same time as this off-exchange trade, and this other thing is also causing this response pattern? Well, if instead of looking at things reported to the NYSE TRF, we instead look at trades reported to the NASDAQ TRF, we're going to get a totally different latency pattern between that other thing that we think is going on and the trade report. So we can isolate just the response to that trade report. And what we see is we get the exact same pattern. Regardless of which trade reporting facility you use, we see first a spike at NYSE, second we see a spike at BATS, and third we see a spike at NASDAQ. So regardless of which trade reporting facility you use, we see the exact same pattern in the responses. We're not done yet. We're going to show you a lot more geographic variation that's out there to exploit. And part of the reason we spent so much time on this is when we started this project, a lot of people that we spoke to told us, look, nobody reads the SIP, nobody uses the SIP, it's slow and it's stale. So we were so surprised. We really wanted to make sure that when we were seeing a reaction to the SIP, that we were really picking up something accurate here. So the other difference that we can exploit is the fact that tape C securities are actually all going to be published by the UTP SIP. So anything that's NASDAQ listed for historic reasons, it gets reported by the UTP SIP, which is located in southern or central New Jersey, right next to the NASDAQ exchange. And what's great about this is now, regardless of which trade reporting facility you use, the signal order is going to be reversed now. We should see the spike at NASDAQ first, we should see the spike at CBOE second, and we should see the spike at NYSE third. And that's exactly what we find. So now this graph is different than the graph before because I'm using tape C securities. So if we look at tape C securities, time 0 is the time at which the SIP starts broadcasting the trade. First, there's a spike at NASDAQ. Second, there's a spike at BATS. And finally, last, there's the spike at NYSE. So if you look at, along the y-axis here, this is the number of quotes per microsecond interval. Really huge spike in activity at each of these exchanges. The other thing you can notice on this graph is that the spike, that very first spike, is a lot closer to 0. And that's because the tape C securities information processor has a much lower latency time. It reports trades a lot quicker than the tape A security SIP. If we use trades, we actually get the same pattern. So there's a spike both in quoting volume and also a spike in trading volume at each of these exchanges, and it's sequential, matching the geographic variation. Another question we got is, well, maybe we're picking up some sort of passive activity, that it's something where people have just some sort of orders that automatically update. So another thing we can use is the fact that the investors exchange, IEX, utilizes a speed bump. Now, what's nice about a speed bump, the way a speed bump really works is it has to be differential. If you slow down everyone, the race outcomes don't change. If you want to actually change, high frequency race outcomes, that's their goal, you have to apply that speed bump differentially. So first, NBBO changes do not have a speed bump. So if an NBBO changes at NYSE or NASDAQ, there's going to be a direct quote feed that's bought by IEX, and they will immediately change any sort of passive orders. What really has to go through the speed bump is any new order. So here I have this person in yellow. Let's suppose that they saw the signal from the CTA SIP and they decide to put a new order onto IEX. Well, their new order has to go through this 350 microsecond speed bump. It'll arrive 350 microseconds after, later than we would otherwise think from the geography. And that's exactly what we find. So the IEX data, their data warehouse is actually very close to the BATS warehouse. If you look at where their spike occurs, it's about 350 microseconds after the BATS spike, which lines up with these being actually new orders. So people are actually actively updating their trades and quotes. It's not something just passive happening at the exchange. It's not like these are just pegged orders auto-updating. People are actively updating their trades and quotes in response to SIP publication of trades. Okay, and I'll show you one last final test of this geographic latency and the effect that we identified here. So within the New Jersey equity triangle, the CTA SIP, as I said at the start, the CTA SIP has historically been a lot slower than the UTP SIP. So trades take a lot longer to be processed and reported by this CTA SIP. But starting in 2020, they made a series of upgrades to the Securities Information Processor, where it started reporting trades faster and faster. So here's the CTA SIP. And if you think about this dashed yellow time, before you get to the geographic latency, there's just some processing time where the computer system, the server, has to process the trade and then broadcast it out. And what happened was there's a sequential reduction of order processing. It used to take the SIP around 200 microseconds to report a trade. They gradually got that time reduced to about 30 microseconds. So now they report trades very, very quickly, conditional upon receiving them. And what we see is actually a matching shift in when these trade responses occur. So now I've switched colors on this graph because what I'm looking at is just activity on, I'm sorry, this is a typo. It should be the NYSE. Sorry, this is just activity on the New York Stock Exchange. That's not a typo. In response to a NASDAQ trade report through the CTA SIP. And now I've switched to blue because we're just looking activity on NYSE. And the reason there's actually 3 different spikes here is that this shows the reduction of processing latencies. So back in August, it took them about 200 microseconds to actually broadcast that trade out. And it's right there at the New York Stock Exchange, so it takes almost no time after the processing. By March, they had reduced the average latency to 180 microseconds. And then if you look at the end of the year, by December 2020, it was down to about maybe 40 microseconds. So this is a final test to be sure that we really are picking up the responses to those SIP broadcasts, is that as the SIP reduced its processing times, we see those spikes exactly shift in correspondence. So this was our surprising result here. We found that people really are looking at the SIP feed for off-exchange trade reports, and that's how people find out about off-exchange trade reports. It's totally different than what you would look at if you saw exchange trades. So if you look at exchange trades, here's the SIP publication. As you can see, that nothing happens after the SIP publication. There's actually a spike before. And the reason is that exchanges have their proprietary feeds. And so if you look at the proprietary feed timestamp, when the exchange is actually broadcasting out that trade, everyone reacts to that proprietary timestamp. By the time the exchange trades hit the SIP, everyone's seen it. So these are also sophisticated players. So I'll highlight the fact that the people who are reading these trades from the SIP, these same people seem to be reading the exchange trades from the exchange proprietary feeds, because we don't see any sort of pattern of trading around exchange trade publications. So that motivates the next thing I'm going to do, which is to look at these trade responses and say, what's going on with these trade responses? And we'll show you, these rapid, sharp responses in response to the SIP publication of a trade. Well, these trade responses actually look like a low latency race. So if you think about what's going on in this race, there's 2 things that people want to do. The first is some people want to update their quotes before trades come in. So these people have quotes and they want to make sure that they don't get picked off. Another thing people want to do is trade before someone has a chance to update their quotes. So people want to snipe these stale quotes. So you think about two papers here, tying back to the literature. Aquilana, Budish, and O'Neill, they estimate that these sorts of low latency races make up around 17% of all liquidity costs. Yang and Zhu highlight one motivation for these races, which is you might want to trade on public information of past institutional orders. So if you see an off-exchange trade and that off-exchange trade gives you information about what large institutional orders are doing, you might want to go to the exchange and trade on that, and there could be a low latency race around that. So what we look at is, what do these races look like? So now we're going to take those trades that happen in each spike. So I've kind of highlighted the regions here. So here's the region for NASDAQ in green, the region that spike in BATS for red, and the reason of this part of that spike from NYSE in blue. And part of the reason these spikes actually get kind of broad is that there's going to be some clock drift. So we're comparing the clock at one exchange against the clock at the other. So sometimes, one exchange is going to be running a little bit faster or a little bit slower. Now, NASDAQ is actually going to have the same clock as the as the tape C SIP in this case. So it's going to be a very sharp spike. If you go to the other exchanges, you're actually comparing against a different clock. So the spike gets a little bit broader. But what we're going to look at is we're going to look in these spikes and we're going to characterize these response trades. So the first thing I want to highlight is that these trades have a very sizable volume, right? So around 2% of all off-exchange trades are going to get one of these response trades. So if an off-exchange trade is reported, around 2% of the time someone trades in response. That's around 160 billion a year in trading volume. There's actually even more in quoting volume. There's around $650 billion a year in quote volume, people updating their quotes, presumably to avoid anyone trading before they have a chance to update their quote. So it's a large volume, but it also appears to us to be informationally motivated. So if we look at these trades, on average, they earn negative realized spreads. So if you think about a realized spread, you're comparing the trade price with the mid quote 5 minutes later. What it looks like is the people who place these response trades, if you look at the price they trade at versus the price 5 minutes later, they make money in that 5-minute interval or in that 30 second. If you compare the mid quote 30 seconds later, whatever it is, it looks like they're earning money from doing this sort of response trading. And the other measure of information that we've been using is the fact that 60 to 70% of these response trades are same direction trades. So if you see an off-exchange buy order, 70% chance that response trade is also going to be a buy order. If you see an off-exchange sell order, there's a 70% chance that's going to lead someone to sell on exchange in response. So it's the same direction pattern, negative realized spreads that really fit with the idea that people are informationally motivated in these trades. Now the overall value here, it's a large volume, but the realized spreads are quite small, around half a basis point. So the overall value here is much lower than the value of exchange data in terms of just the public value. But the final thing I'm going to highlight here is this complex information flow. So if you think about the people doing this off-exchange trading, a lot of them are also some of the same names that do a lot of on-exchange trading. They're going to trade both on exchange, but also off exchange. And their off-exchange trades can actually influence their on-exchange trading behavior. And if you think about it, we're going to have here a separation between the public value and the private value of the data. So if the public value of just knowing at the red point, right, part 2, when you know that the off-exchange trade has taken place and has been publicly reported, there's some value there. But there's also value to, let's say, myself here in green, Tom, where I know before anyone else in the market that I've traded. So we're going to show you a little bit of evidence that this goes on. So what we're going to do is we're going to be looking far before this SIP broadcast. So here in red at time 0, I have the SIP broadcast of a trade. It broadcasts out that a trade has occurred. So we're going to go back in time to this orange section, which is what happens at the time that I make this off-exchange trade. And there's going to be 2 things that I'm going to think about, 2 possibilities that I could do. The first thing I could do is simultaneous routing. I could trade off exchange and on exchange at the same time. If you think about simultaneous trading, the exchange piece is going to be reported right away. The off exchange piece is going to be reported later. And people will say, oh, the exchange is where the price discovery happens because it's reported first. economically, I think this calls into the question, what are we actually saying when we say, oh, price discovery happens at point A versus point B, which is that, the same trade is taking place in both these facilities at the same time. Then really, one thing I want to highlight here is when we measure price discovery, we might just be measuring the latency of a facility. So that's one possibility we're going to look at, is how much of this is simultaneous trading. And then the second thing I'm going to look at is how much of this is subsequent routing. So the idea of subsequent routing is one trade is going to happen first. Say I trade off exchange, and then motivated by that trade that I do off exchange, I then go to the exchange and trade on exchange. And here you could argue that the price discovery is maybe happening in this first trade that's motivating that second exchange trade. And here there's going to be a difference between the public data and the private value of the data. So the public value of the data is when people, 3,000 microseconds later find out about my off exchange trade. The private value to me is that I can trade well before that, well before anyone else knows about my trade. So what we're going to do, we're going to go back in time and look at a set of off-exchange trades that are timestamped 1 to 2 milliseconds before the SIP broadcast. Now here we're a little bit limited by the granularity of our timestamps. So what we're going to do is we're going to have this broad orange region, and we're going to say, okay, in this broad orange region, that's where off-exchange trades are taking place. They eventually get reported at time 0. So we're going to look at the pattern of activity around the time that trades are actually taking place. And this is the pattern we find. Across all the exchanges, there's a lot of activity that happens before off-exchange trades are reported. So these are these little response spikes where people see that off-exchange trade and they rush in or trade in response. If you look at those actually off-exchange trades, they seem to often have an on-exchange trade component. And we actually see some evidence for the simultaneous pattern. So this is cases where someone is maybe sweeping the dark and the lit together. The on-exchange piece gets reported first, the off-exchange piece gets reported later. And so people find out about the on-exchange piece here, and then maybe they respond to the off-exchange piece. We also see some evidence for that subsequent routing system. The idea here is someone trades off-exchange, then motivated by that, they go and trade on-exchange before anyone else is informed about the trade. So this reflects the idea that there's also private value in the off-exchange data here. There's private value from that latency. Okay, so with that, I think I'll finish a minute early by concluding here, which is, thinking back to those overall trends, you're thinking motivating trend 1, on-exchange data has become incredibly valuable. Trend number 2, so much of the data is actually occurring off-exchange, so much of the trade data. So there's 3 things I want to highlight with this paper. So the first, well, we saw that off-exchange trades are reported with this huge delay. So if an off-exchange trade occurs, it's not reported to the market until thousands of microseconds later. And this is really an important part of post-trade transparency. And some of this transparency comes from embedded latencies that we really couldn't get rid of. We can't get rid of the fact that markets participants are spread out geographically. It's going to take time to report trades publicly. And the second thing I want to highlight is when these trades are actually reported, we really do see market reactions. So this is maybe a weak straw man, but something some people told me when I started working on this project was, oh, the off-exchange data, it's not valuable. No one looks at SIP. No one cares about the off-exchange data. We actually see these flurries of trades and quotes in response to off-exchange data. And we're certain that's what we're seeing because we can exploit the geographic variation in data centers. And it really looks like an informed low latency race. We see buy orders following buy orders, earning negative realized spreads. Then the final thing I want to highlight is, when we think about measuring, say, the value of data or where price discovery is occurring, we have to make sure that we're not just measuring latency, right? There's a complex information flow here where investors will trade both on exchange, but also off exchange. And their off exchange trading can actually influence their on exchange trading behavior, which creates this internal value of the data separate from the external value of the data. And with that, I'll thank you all very much and turn it over to Carol or Dominic.
Thank you very much, Tom. Right, perfect timing. So our discussant for this paper is Dominique Roche. Dominik is an assistant professor at the State University of New York at Buffalo, and I'm particularly appreciative that Dominik has agreed to discuss this paper. He did it agreed at the very last minute. So thank you, Dominik, and over to you.
Thank you very much for the introduction, and thank you very much for giving me the opportunity to discuss this very interesting paper. So what the paper does, it shows that the report of off-exchange trades is correlated with on-exchange trades, and they argue that this causes on-exchange trades. So the report of off-exchange causes the on-exchange trades and the quote updates. And even further, they argue that they cause on-exchange trades and quotes because the off-exchange trades have information. And because of this information, it justifies their title. So off-exchange data is valuable. What they do for identification, they exploit the market microstructure, as we saw in the document, in the presentation. So figure 5 and figure 6, they show like the latencies between the SIP and the different exchanges. And then in the following figures, they show the quoting activity or trading activity that happens on the exchanges with respect to when an off-exchange trade gets reported. So note that these latencies between exchanges and SIP is two ways. So therefore, we know that the exchange sees the off-exchange trade at the SIP time, so the reporting time, the time when the trade leaves the SIP, plus the latency, whatever it is, to the exchange. So if you look as an example, maybe there's a retail trader, he trades on Robinhood. Robinhood sells the order flow to Citadel. I don't know if Citadel is a FINRA member. Either way, one of them will report it to the trade reporting facility, which then ends up in the SIP. So now we get timestamp, the SIP timestamp when this trade gets reported. And the latency to the NYSE is like 260 microseconds. So we know that when we look at the participant time, and we find that the peak of the participant time, so the people that trade or quote on the NYSE, is equal to the SIP time plus the latency. We know that it happens exactly when they first see it. But also note that means it can only be a co-located algorithm because no other one can react so quickly. So the setup, it's a very elaborate introduction into the plumbing and the market microstructure of the US exchange market. I mean, we saw it in the presentation as well. Unfortunately, the data details are missing. So not only the data details, so the details of the timestamps, the details of the TAC, also the way of how the figures are created. So there's a couple of things that are not clear to me, which I list here. For example, whether they only restrict themselves to regular trading hours. Also, the trade reports can be quite delayed. So as far as I know, the obligation for an off-exchange trade is that it's reported within 10 seconds. So it has to be reported as fast as possible, but within 10 seconds. If not, it should be marked as late. So maybe that's an interesting setup as well. I mean, either dropping these late trades or even focusing on them and see as a robustness test. But I mean, I also didn't find a definition of off-exchange trades. So I guess it's the exchange is equal to D in TAC data. So there, I mean, the graphs, I will also show you in a short while, look relatively simple, but there's a lot of details that go in. And I mean, I replicated this graph, figure 9, and I just show you my choices. And so, for example, I only used like trades between the continuous trading times, so 9:30 to 4 o'clock. In this case, I only looked at the trade reporting facility of the NYSE. Then now the different timestamps. So I said in TAC data, there are 3 timestamps. One is the SIP time, so the normal timestamp, which is when the SIP sends out the data. One is the participant time, so when the trade occurred at the exchange. And there's another another trade timestamp, TRF timestamp, which I'm not sure if the authors use, but so in this case, we use the participant time, so the time at the exchange, except for the off-exchange trades, so where the trade exchange is equal to D, which is here in the second block, there we use the SIP time. So this gives us a new ranking in the times. Then what to do with consecutive off-exchange trades? I mean, think about overlapping events. So I just drop them. I only look at the last off-exchange trade. Now, how do you calculate the time between on-exchange and off-exchange trades? So I choose to only look at the time between the on-exchange to the most recent off-exchange trades. So the good thing is all these choices lead pretty much to the same figure. So I think that's very reassuring that it's probably not the exact choice. So this one shows you the number of trades for January to May 2020. Trade facility is NASDAQ, looks at NASDAQ stocks, so tape C stocks. And on the top, you see the reaction on NASDAQ, and then the bottom and the NYSE. And the same as the figure reported in the table, you see that the NASDAQ reports very quickly because NASDAQ is very close to the SIP for tape C stocks, and NYSE reports with a delay. Similar, you see it when you look at the trade reporting facility of the NYSE. I found that when I looked at tape A and B stocks, I couldn't replicate it. It looks different. So I only used 3 months, January to March 2020. There I have 400 stocks that are tape A or tape B. So similar as before, the top shows you the reaction on NASDAQ, the bottom to the NYSE. Now we would expect the NYSE to react faster because now it's the SIP which is very close to the NYSE. So the SIP time from to NASDAQ should be 500 microsecond, to NYSE 260. So here it seems to happen more before. So in general, these figures, I mean, from what I replicated, we can see that these off-exchange trades not always associated with on-exchange trades. And I mean, in a way that seems also consistent with what they report, because they report that only 2% of dark trades have an on-exchange response trade. So I wonder, these figures, they might obfuscate like some potential confounders. I mean, they are nice to see, but in a way they could be driven by some events. I mean, trading often clusters per stock, per time. I mean, Thomas mentioned the meme craze on GameStop and so on. So the question is, are these 2% different with any respect of time, size? So I was thinking about potential alternatives. So for example, I mean, what happens in 2020, GameStop? So there was suddenly a vast increase in off-exchange trading. Maybe that led to a bottleneck. After all, these trades can be reported within 10 seconds without being marked as delayed. So maybe there were suddenly a lot of off-exchange trades in bulk, and then they will have a price impact. But this price impact might not be larger than on-exchange trades. It might just appear larger because there were suddenly so many trades reported in one go. Alternatively, second alternative, maybe it involves the same parties, maybe a Citadel, which executes a trade for the payment of order flow of the trades to unwind the inventory. That would explain why the following trades have the same sign. I mean, if you think that the retail trader initiates the trade with the Citadel, and then the Citadel initiates the trade to unwind the inventory, both would have the same sign. It would also explain why the realized spreads are negative, because after all, you have price impact, you might quote below fundamentals to unwind the inventory. I mean, there are good reasons why that is probably not the story. I mean, the setup would allow to rule out some simultaneous reactions. Let me skip that in interest of time. The third alternative, I was thinking, fractional shares, they can be I mean, they will be reported, but they will be reported as one share. So what happens if there's 100 trades of actually 0.01 shares? They will be reported as 100 trades of one share. And that does happen. So I looked at actually just an example, random example, GameStop, where I knew there was a lot of crazy stock trading going on. I mean, this is like 2nd of January 2020, and you see all these trades. So they all occur consecutively, and they all have a size of 1. So they could have a size of 0.01. And again, this would lead to a price impact, and it would just appear to be larger. And in fact, it could be very similar to what happens on exchange. So in general, I think it's important to think about potential confounders, like the trade size, the number of trades. It's also important to think about the actual channel. I mean, I'm still not convinced that it's information. In my view, it could be illiquidity as well. Maybe it would help to think about good counterfactuals. I mean, for example, you have stocks with different share classes. I mean, if it's information, I would assume that it should affect both share classes the same way. If it's liquidity, it should affect the one where the trades happen, so the class where the trades happen much more than the other class. I mean, there might be some spillovers, but still I would assume that it's more prevalent in the share class that was actually traded. So in summary, I think it's a great read. I learned a lot about the US stock market setup, the SIPs, the TRFs, and so on. I think it would be great to add as much details about the stock market and the data and the implementation. And I think it would also be nice to move away from the figures and more kind of come up with a statistical model that really makes use of these different SIPs, different TRFs, which would be easier to read. Maybe a different diff would help, maybe looking at different share classes. And the last point, I mean, it's called the value of exchange data. I mean, so far, it more looks like in a window of how co-located algos trade. I mean, after all, it must be from co-location where the response trades come from. But maybe it would be worthwhile to calculate trading profits from the trades that happened before, or something more towards the value of the off-exchange trades data. Sorry. But all in all, a great paper. Thank you very much for the opportunity, and thank you very much for your attention.
Excellent. Thank you very much, Dominique. We don't have any questions yet, so a reminder to the audience that there is a web chat available for you to send through your questions as we present. So we have a few minutes in the absence of questions for Tom to perhaps give us a very brief response.
Yeah. So first, thank you very much, Dominik. Not many authors get to have their discussant replicate their paper, so I'm very happy to be confident and show. I think hopefully everyone knows that not just I'm saying this, but you also confirmed. And I take your point very much. I will make sure to rewrite the paper to make the trade parts very clear. But it looks like your assumptions were all quite reasonable and led to the same figure. So I think the other, in terms of broadly, the thing you suggested, which is that, is the 2%, how does that vary across time, across months, across stocks? I think that's a great suggestion. We'll dive into that. I think dropping those one share trades, that's actually something that's running on the server right now. That's a very good suggestion. I'm also hoping that maybe it'll jump above 2%, because right now we're seeing 2%, but who would ever respond to those one share trades? So I'm actually hoping that the response rate is even higher than 2%. I guess I would push back, and I don't know. I think you also maybe said that this alternative would be unlikely. The idea that Citadel themselves are trading in response to their own, because Citadel is not going to learn about their trades from the SIP. They're going to learn well before, they know right away that they've traded. So they're not going to be learning about their own trades from the SIP. But it could be like Citadel learning about Virtu's trades or Virtu learning about Citadel's trades. But with that idea, one of the things we're really working on right now, which we're hoping to get into the next draft of the paper, is looking at how Citadel would trade, because they know, right away when they do a trade, they know, well before the SIP reports the trade. So one of the things we're really looking at right now is, what does Citadel do on exchange? Do they seem to be, buying or sell? And I should say not just Citadel, any sort of off exchange participant. What are they doing on exchange? And so far, the paper is just using TAC data. So everything is publicly available. So just as you were able to replicate it, it's all public data.
Excellent. Thank you very much, Tom, and thank you, Dominique.